Hi, welcome to our 2-Minute Tuesday for March 10th of 2015. This is Roger Balser of Balser Wealth Management. Our topic for this week is Apple joins the Dow. It doesn't really matter. Last week, the Dow Jones Industrial Average became just a little more hip. It did not, though, become more relevant. In ditching the old flip phone AT&T for the iPhone Apple, the index both modernized its components and shows off why it's an outmoded, anachronistic model of the stock market all at once. In fact, you could argue the news proves the point, as many investors would have assumed that a company as important as Apple must already have been in such an important measure of the market, while others will now be shocked to learn that a stock as respected as AT&T is on the outs. The latest move pretty much confirms the Dow is like People's Magazine's list of the most beautiful people. The Dow is filled with current and classic beauties, but the real news that represents what is happening in the market is in a much broader cross-section of what's happening now. Adding Apple doesn't change that. The Dow is the celebrity number of the financial world, but not the meaningful one. The Dow is important to people because it's what they know. The staple of every market-oriented website, every radio station market update, every newspaper's daily business section, and the centerpiece of the 20 seconds of coverage that every national newscast guarantees the investing world each day. But that's precisely what makes it a celebrity index. A celebrity is someone who is famous mostly for being known. It's the Kardashian sisters, who you may have heard of and be curious about, but who don't appear to have any particular talent. The Dow as an index is not talented either. That's why it hasn't been important or meaningful in the investment world for a long time. For more than a decade, investors have been talking about the market, have been referring to the Standard & Poor's 500, or more importantly, the Standard & Poor's 500 equal weighted index. The Dow was too thin and poorly constructed for anyone who is in the know. Instead, the Dow is a price-weighted average of 30 actively traded so-called blue chip stocks. Price weighting an index is old-fashioned and outdated. It means that each stock influences the index in proportion to its price per share, so that a stock trading for $1,200 per share has 10 times the pull of a stock trading at $10 per share. By comparison, a cap-weighted index like the S&P uses the market value of the listed stocks as the basis for how much weight they carry in the benchmark. At Balser Wealth Management, we use the equal weighted index. Each stock pulls the same weight. Our relative strength work tells us that this is superior to the price-weighted methods of the Dow. And as for the blue chip stocks, that term is also outdated. It is no longer unique to Wall Street. There are very few mutual funds that still have it in their name, and they benchmark not to the Dow, but to the S&P 500, all of which brings us back to the need to de-emphasize the Dow. The media must stop reporting ordinary mile marker numbers as if they are meaningful. It needs to cut down on the coverage of triple-digit days as if 100 points, a move of roughly 0.5%, is some kind of a big deal. The 100-point moves that were a big deal back in the late 1980s, today, they're a waste of emotion. The media is dishonest when it puts much more energy into reporting down days of these levels with much more vigor than the gains of the same percentage size. The percentage move is the same, the emotions about that move should be the same. The media needs to help the public accept a new, more appropriate and meaningful index and use that benchmark to reset the scale of public expectations. This has been Roger Balser, Balser Wealth Management. Thanks for listening. If you have any questions, thoughts, or concerns, please get a hold of us. As always, make it a great week.